Hey everyone, today on the final bar, we'll talk about the S&P remaining range bound just below that key 4,600 level. Ari Wald of Oppenheimer joining us from New York. He'll compare the short-term risks with the long-term uptrend. Finally, 10-year yields pushing back above 4%. How much further upside for interest rates, and what does that mean for growth stocks? Ladies and gentlemen, this is the final bar. Hey everyone, Dave Keller here with StockCharts.com. Thanks for joining us every weekday after the close for our show. We are here in a very warm and sunny Redmond, Washington. Happy to bring you some market updates and the latest thinking on technical analysis, looking at the charts, reflecting what's happening, the buying and selling, the uptrends and downtrends, the push and pull between investors, all of that reflected in the charts. At the end of the day, I would argue as a trend follower, your goal should be to identify trends, to focus on what's working and what's not, to follow those trends, to put yourself in a position to profit from the fact that markets tend to trend and trends tend to persist. And then finally, and arguably most importantly, recognize when those trends have shifted. A lot of times I've found investors and traders get into all sorts of ugly positioning when they hold on to things that are no longer working. Technical analysis is fantastic because it tells you what's actually happening, not what could happen or should happen, what is happening. So let's focus on price and trend and momentum, all of those data points that can help us really understand investor psychology and most importantly, how investors are voting with their capital, where they are putting their bets, and what that does, how that's reflected in price charts. So I mentioned in the introduction, the S&P 500 still sort of range bound. We sort of pushed up to 4,600. Last week we had the Fed meeting, a bit of choppiness, bit of distribution. So far this week, really unable to follow through to much upside. So I tend to think of a market in one of three phases at any time. It's in an accumulation phase, meaning higher highs and higher lows, a distribution phase of lower lows and lower highs, or a consolidation phase, somewhere in the middle, where buyers and sellers are generally in agreement. We're in some sort of equilibrium. In the last week or so, it's been sort of an equilibrium play in the short term. However, we'll talk about with our guest today, Ari Wald of Oppenheimer, how the long-term trend, of course, still seems fairly strong. So let's think about the tactical, the short-term time frame versus the long-term time frame as we get into our market recap. As I mentioned, as we look at the charts here overall, the S&P 500 languishing. Let's ask you, our viewers, where do you think the S&P 500 will be at the end of this year, December 31st, 2023? Above 4,800, most of the respondents there, at least the most responses for that one, 44%. 24% of you said between 4,800 and 4,500, kind of the current levels that we're in, not too much lower. And then 42 to 4,500, and then below 4,200, about 19%. So I'm really interested in the Uber bears, as I will call you, with the S&P going below 4,200. What all you're thinking that gets you to that point? It's certainly possible. And I will tell you, first off, we'll know the right answer as of 12/31/23. But between now and then, I think it's healthy to think about what I call a probabilistic analysis. There is a possibility that the S&P goes above 4,800 and keeps going. It gets to 5,000 and maybe even pushes much higher and ends the year at 5,500. I don't see that as the most likely scenario, but it certainly is theoretically possible. There's another scenario where the S&P goes down to the February high around 4,200 and just doesn't stop and breaks below the 200-day. And all of a sudden, we're talking at year-end about retesting the lows. Again, I don't think that's the most likely scenario, but it's possible. So remember that there are different outcomes that we can prepare for by thinking through those scenarios. As I ran cross-country in high school, our coach would make us visualize. We'd have to lay in a room with the lights off and visualize the entire race of 25 minutes and think about, for me, it was more like 28 to 30 minutes for the record, but thinking about every step of that race, thinking about the course and making sure we visualized it. Do that as an investor. Look forward and think about where the market may be headed to. I would say the move below 4,200, I would agree, pretty unlikely. So I get the point that some may be bearish. I would argue, and I was talking with Ari Wald, my guest today before the show, what sort of buying opportunity would a lot of investors be expecting if the price of the S&P came down another 300 points? How attractive would the market look as these charts and strong uptrends pull back to much more accessible levels? I would argue it's hard to not imagine buyers not coming in and buying in on that short-term weakness. Above 4,800, though, I think is tough, only because it depends on what sort of pullback we're going to have here seasonally. I would probably vote between 4,500 and 4,800. I wouldn't be surprised if we end the year not too far from current levels. We'll see. We'll see what the charts tell us through the remainder of this year. Let's look elsewhere at the markets today and see what happened. Then we'll look again at sort of how that fits into the longer-term trajectory of markets and trends. The S&P 500 down about 0.25%, finishing the day just below 45.77. The Nasdaq Composite down a little bit more. The Dow actually finished in the green, up about 0.2%, so not much of a big up day, but certainly outperforming the other two major U.S. benchmarks. Small caps down by about 0.5%, so matching basically the return today of the Nasdaq Composite. The VIX pushing back up, but let's keep in mind these are relatively low volatility levels down in that 12, 13, 14 handle. These are pretty low relative to the last couple of years in the VIX, but that's sort of where we've ended up. 2023, as I've mentioned many times, a lot like 2021, it turns out, with this slow and steady grind higher highs, higher lows, minimal drawdowns, low volatility. Very similar environment. In 2023, of course, it's been about the domination of some of the mega cap stocks. We'll come back to that theme many times, I'm sure, in the coming days and weeks and months. Let's look at the fixed income markets. Quite a bit of movement here, actually. Bond prices coming down today. The TLT was down by about 1.6%. Interest rates overall moving higher, with the 10-year point on the curve up back above 4%. The 5-year and 30-year points now all back above 4%. So rates have been sort of languishing, coming off of highs earlier this year. We can see now a rotation back to the upside. We'll look at the chart of the 10-year yield here in a few minutes, but 10-year yield back above 4%, 10-year even higher to 4.1, 4.2. If it goes above the previous high around 4.25, what does that do for growth stocks? And the short answer is it doesn't tend to be a great sign, and only because the growthy part of growth, the future earnings growth, becomes less attractive if interest rates now are higher. And so that's a challenge to sort of the long-term growth thesis or outperformance thesis. Is higher rates don't tend to be a great playground for that sort of move. The dollar index up about 0.5% using the UUP ETF. Looking at commodities, we talked yesterday about the rotation higher that we've observed in commodities. Energy was the number one sector yesterday. Today, not the same. A bit of a pullback after yesterday's nice green day for all these commodities. The DBC down about 0.5%. Silver prices down 1.8%. Copper prices 2.5%. Crude oil not too bad relative to yesterday, but certainly a different feel to the tape today from yesterday. Bitcoin and cryptocurrencies bounced higher through the equity trading session, getting back up toward that big round number of 30,000, which we've talked about. Not quite there. And Bitcoin essentially getting back up to a zero level from yesterday's close at the end of the 24-hour session yesterday. Looking over at sector returns, only a couple in the green by the end of the day. Industrials and technology, both up, but both of those not by much, 0.2, 0.3% each. Everything else was in the red. The worst performing sectors today, utilities down 1.25%, consumer discretionary down 1.2%, healthcare, the XLV down 0.5%. And if you're looking for charts that are fairly distributive, right, what I mentioned, charts in a distribution pattern where you have lower lows and lower highs, I would probably, if I'm looking for some examples, I'd be looking at staples and healthcare. Those are two sectors down about 0.5% today. And again, I think that's just the latest downtick in a period of underperformance that certainly doesn't show signs of slowing anytime soon by my work. Let's look at a daily chart of the S&P 500, sort of check in on where we're at relative to where we've been. As we think about today's session, that's the little choppy period here, just this little session. As you can see, the last week or so has been right around in that same range. It really goes back to the third week in July, we'll call it, as we rallied and made a new swing high. We got about 45.50. From there, it's been kind of sideways. This was last Thursday, which was a big bearish engulfing pattern, but the market really didn't follow through to the downside. It sort of remained in this range. So what's interesting is in the last 2 weeks, with a lot of news flow now in the meat of earnings season, equities are sort of sideways. Now, there's been some, I would say overall, if you had me pick the direction it has to be up or down, I would say the direction is still up by the fact that trend lines are going higher and the prices above those upward sloping trend lines. But again, I can't help but notice that the market sort of stalled out a little bit here in the last week or two. Yesterday, if you missed yesterday's show, I would encourage you to go back. On Monday, we talked about what's called accelerated trend lines, and that is when you have a trend line and then the price gets away from that. So you have to draw another trend line of an increased slope. The price gets away from that. And what you're basically doing is accelerating the trend of the market and matching the accelerating uptrend with trend lines of increasing slope. This last one is the one we drew, and it's really matched the trend in the market for the last 8 to 10 weeks. And I would say as long as we hold above there, the trend is still positive. We break below there, the tactical trend may be a big question mark, and we'll have to see. But for now, higher highs, higher lows, that's an uptrend, and that's kind of it's kind of what we're seeing right now. I mentioned interest rates. I want to look briefly at the chart of the 10-year. On our platform, $TNX is the way that you access it. You know, it's an interesting chart. This is what I was just tweaking the chart earlier today, just looking around at some different time frames. You know, my sort of overarching theme on the 10-year was, the making a new high in rates really for the cycle here around 4.25. That was in October of last year, and that was when the equity markets were bottoming out. Rates were rising, of course, and the 10-year yield topped out for now just around 4.3%. We then came down from there, and from that point, it really was sort of a downtrend from October of last year, really through April, May of this year. From there, we started putting in some higher lows. 10-year yield sort of stabilized around 3.25, 3.3%. Found a floor there, didn't get much below 3.3%, and then rotated back to the upside. We broke above a trend line using the October high and the March high. You can see we broke above there at the beginning of July, right around 4th of July, pulled back basically to that trend line and now rotating back higher. We're now testing the March high, which lines up with the high from early July, which is right around 4.1%. We get above that level, and all of a sudden, I think it's hard to argue that this has done anything but rotate back to an uptrend. And higher rates tend to have some implications. In general, falling rates or low rates tend to be better for growth stocks because you're pricing in future earnings. Those future earnings certainly look more attractive with lower rates now. It shows the potential for future gain. Rising rates tend to be much better for value stocks, much worse for growth stocks, and we can see that the trend in interest rates has been higher for the last couple months. Right, take the April low to where we're at now. You can see we've gone up quite a bit, about 0.7%. Now at the bottom, though, you can see the relative performance of value versus growth. So while rates were kind of pulling back, stalling out sort of in the upper 3% range, you can see value stocks underperforming, growth stocks actually having room to do quite well. Now all of a sudden rates are rotating higher. Growth stocks have really still hung in there, and value and growth are sort of in tandem. They're sort of both moving higher together. What's interesting is growth stocks for the most part are still going up. It's just the other stuff is now starting to perform well also. Sectors like industrials, energy, and materials, which we highlighted on the show yesterday, even financials at times have rallied, and that's caused basically everything is starting to go up. Breadth conditions becoming much more constructive, if not excessively bullish, because we've had a lot of these other names start to rally. So my question would be, do we get a tactical pullback in growth? Do we see areas like materials tend to do better or start to do even better? And that causes this ratio to go higher as interest rates continue to push to the upside? Open question, but I think this chart of the TNX is important. And getting above 4.1% would really complete that rotation. You could call this a cup and handle pattern with a breakout. With something like interest rates, I'm less excited about labeling it a cup and handle pattern and more just looking at the trends of highs and lows. And I think getting above 4.1% could be a nice upside follow through. Heavy earnings week this week. We'll debrief here briefly at the remainder of our market recap on some of the stocks on the move. Eaton Corp, shout out to Northeast Ohio company. In the industrial sector, we have a couple industrials like Caterpillar, Stanley, and others that reported today. We'll look at Eaton Corp to start with, up over 6% today, a nice gap higher, gapping, opening just above 210 and continue to push higher. Gaps are always interesting to watch to see what happens leading up to the gap, the day of the gap, right? And what actually happens after that higher open. You can see that additional buyers came in. There's additional buying power pushing prices higher. It's always interesting to see the next day too, right? Now that we've sort of registered, okay, Eaton was up pretty big today. Do you see additional buyers coming in on Wednesday, on Thursday, and Friday, showing that not just they were excited about this quarter, but more, you're seeing further potential. You're seeing additional demand come in. But for now, the trend in Eaton has been strong. We put in a higher low around 200. We're now gapping higher. I think holding above that gap level around 210, pretty important. But overall, the short-term trend has remained pretty positive. Caterpillar is another industrial stock gapping higher today, almost 9% higher today. Closed around 289, and that's after closing yesterday just around 266. So a gap higher and then a lot more upside through the course of the day today. What's interesting is today's gap higher actually completes a breakout above resistance around 265. That was the high from January. That was the high from mid-July. We pulled back just a bit and now gapping higher and pushing to the upside. That seems like a good breakout out of a basing pattern. Interesting to see a move higher there. You know, Stanley Black Decker in the same sector, industrials, a very different look to this chart. Eaton and Caterpillar have shown some strength, and Stanley's a little different in that 2022 was an absolutely brutal year, and from October of 22 to really mid-year 23 didn't go anywhere. So while the rest of the market's starting to recover off of those October lows, Stanley Black Decker is actually remaining down in that $70 to $80 range for most of that period. Now look at how that's changed. When I talk about the different phases, a distribution phase, that's what 2022 would be like. A consolidation phase is where we're in a sort of basing pattern, a rectangular pattern. You could draw a big rectangle around the price action, and it captures most of the trading. That's what I think Stanley was doing during this period. From June 1st on, though, it's been an uptrend. It's been higher highs, higher lows, and we broke above resistance at 95. It's a nice up day, up almost 5% again today, but I think that's the latest move, just continuing this uptrend, getting above 100 today. Big round numbers tend to be important for stocks and for a lot of other asset classes, ETFs as well. So pay attention to see if Stanley Black Decker can remain above that crucial big round number, $100. Things that gapped lower today, we just have a minute left. We'll look at Norwegian Cruise Lines, NCLH, CCL moving down as well. Cruise lines have been a pretty attractive part of the market, really breaking out of this range. And I think NCLH getting above 18, getting above the November peak and the February peak was pretty impressive. You had a brief pullback in June and then a new swing high, topping out just below $23, getting in the range of the early 2022 highs. Today's gap actually puts it down to the 50-day moving average. What's interesting about this chart as we wrap up our market recap is we've traded down to the 50-day but closed back above it. The 50-day moving average, often sort of a good visual cue, is to see if a pullback is a good pullback, sort of a viable pullback within an uptrend, or the beginning of much further deterioration. Whether a stock is able to hold that 50-day or that 10-week moving average can often be pretty interesting. I'm noting how Norwegian Cruise Lines, again, still down 12% today, but did not close below the 50. They actually closed back above it. I will be watching the rest of this week to see if that key level of support can continue to hold. That's our market recap for today. I want to bring on today's guest, Ari Wald from Oppenheimer, here in a minute. Before we do it, a couple brief announcements. First off, our mailbag could use more questions. What are you running into as you are analyzing the markets using the Stock Charts platform, using the best practices of technical analysis? We are here to help you along in your journey. Our email is thefinalbar@stockcharts.com. We're on X or Twitter, whatever you'd like to call it, at FinalBarSCTV. And on YouTube, of course, just put a comment below the video you're watching. Our channel is called Stock Charts TV. Subscribe to it. Why don't you while you're there? But also just drop a comment below the video you're watching. We'll gather all of those comments and hope to answer your question in our next mailbag segment at the end of the week. Also, another quick announcement. I will be speaking at the Money Show next week in Las Vegas. If you go to stockcharts.com/money show, I'll be giving two presentations next week, one on Tuesday, one on Wednesday. One of them will be a shorter half-hour session talking about some of the key charts I'm watching between now and year end. I'll also be doing a 2-hour masterclass focusing on the checklist that I use to analyze most charts that come across my monitor. Go to stockcharts.com/money show for more information and to sign up for both the free and the premium event coming up next week at the Money Show in Las Vegas. I want to welcome on today's guest, Ari Wald. Ari's the head of technical analysis at Oppenheimer, coming to us from New York. He's been a frequent guest on Stock Charts TV and always does a great job of bringing some charts that help make me think. Ari, it's great to see you. How have you been? Okay?
Things are well, Dave. Thanks for having me back there. Yeah, a lot more less volatility this summer than we probably spoke a year ago.
Right? It certainly seems like the market has been settling into this nice, slow and steady uptrend. We're sort of in that summer doldrums period. We're entering a seasonally weaker part of the markets of the calendar year. So I'm very interested to hear how you're thinking of the conditions here. We're starting with your chart where you really address the relationship between the long-term trend and the short-term risk. Talk us through this chart and what it tells you about the conditions here.
Yeah, we're trying to navigate these different time horizons, and for us, the long-term positives still outweigh the near-term negatives. The near-term concerns can be that the market is entering the seasonally weak period between August and September, and on top of that, can be considered overbought, trading over 10% above its 200-day average. But actually, that's a good thing, the extension above the 200-day average. What we found is that's actually been followed by above average returns. That is consistent with a confirmed uptrend. So what that indicates to me is that any seasonal setback that we get here, Dave, one, it's going to be temporary. Two, it's going to be difficult to time. And three, it's going to provide an opportunity to buy a bull cycle that we think is still in its middle innings. We're also flagging some similarities in the chart looking back at 2020. The first time when you got above 10% in August, there was a bit of a seasonal setback there. You had to be ready to buy right away. What was interesting, if you actually then sold at peak deviation in December of that year, you never even got that opportunity to buy back. And then conversely, the indication of the top later in 2021 was a divergence, a new S&P high, and a failure to get above 10% in that indicator.
It's interesting how the pace of that incline sort of slowed at the end. That divergence really a different look than what we're seeing. We're not really seeing any sort of divergence now. You know, I know some people, individual investors, when they look at this sort of market, and you see the seasonality. A number of people have talked about the seasonal trends. August, September tends to be pretty rough for stocks. What would you say to someone who's hesitant because of seasonality versus what the trends are doing? And I guess another way to phrase it is, how do you weigh the seasonal tendencies with the trends we're seeing in the market now?
Well, for us, seasonals are secondary confirmation. You know, we're never going to invest based solely on historically what the market has done during a typical time of year. But when it confirms what our primary indicators are indicating, it gives us all the more conviction. So last year we had market bottom conditions and a presidential cycle that has historically been known to create market bottoms. Fast forward to today, we're entering this weak seasonal patch, but a uptrend that suggests put less emphasis on that. Don't try to time the pullback. If you do get one, though, you do want to buy it and use it as an opportunity.
That's well said, Ari. Thanks for talking about that relationship. I love the focus on trend. What's happening now, probably most important out of anything. We're in agreement on that point, I think 100%. Your second chart, similar look, but looking at the Nasdaq 100. How does that compare to what we talked about with the S&P?
Well, these large cap growth, broadly speaking, can be viewed as the established leaders. You know, for our vantage point, that's what you want to stick with. That's what you're looking to buy. You know, that I think is the area that it likely remains a leader and driver of this bull market. Now, with that said, there's concern about how extended that index has become. And in fact, you know, it's been almost used as a bearish talking point. The fact that the Nasdaq 100 is over 20% above its 200-day average as an indication of fraud. But here's the thing. That's why you got to back test your indicators. And what you would find is that historically, this is actually a very good thing for the NASDAQ. The NASDAQ 100, Dave, has posted its best forward return 6 to 12 months later when at least over 20% above its 200-day average. What I'm flagging here also is that if you look back, we counted a few other occurrences when this index moved from 20% below the 200-day to 20% above the 200-day within a 1 year's time. 1991, 2003, 2009. You know, all periods coming out of a bear market, you know, confirmation of a new bull market that continues. So the market is behaving in a manner consistent with a trend that should continue.
It's so interesting. I think we're so programmed for some reason to think about, you know, overbought, overextended, all these words that have a negative connotation. When you look at the history, it actually often happens not at the end of the game, but sort of in that second half, right? The first half type of thing where you have much further upside to be had. It represents that there's a lot of upside momentum behind where we've come from. It's a great chart. Your last chart looks at banks, so it's so interesting. We were laughing before the show. We have these great charts showing us further upside potential. Give us a short idea, right? Where should we be underweight? Talk us about banks and how they fit into the picture we've described so far.
Sure. Yeah, right. So what's the tactical trade here? You know, the market is a bit extended here. I think a setback would be likely. But again, we're looking to buy the leaders on pullbacks. We don't want to sell the leaders that have worked. What we do want to sell, we want to sell the bearish charts here. If the market's going to set back, we're of the view that the weak get weaker. And probably one of the weakest charts in the market from our vantage point is the banks industry. KBE is the ETF that I'm charting here. It's actually had a great July. It rallied significantly from those low levels in the second quarter, but it's rallying into resistance, a rally in a downtrend, into the bearish slope of its 200-day average, which we define as a near-term opportunity to sell long-term weakness. So as I think about areas that I don't necessarily want to buy back, or that could be at greater risk, or where I see less upside potential, it's all about risk reward. And for us, banks have a poor risk reward. And I think with the market overbought, the tactical trade is to sell banks here, and we moved them down to underweight.
It's really interesting. And again, some of the financials I feel like have been such a non-factor for a while, but you've seen this renewed strength in the short term. But totally get that it's rallied up to some key levels of potential resistance. If we could, with the time we have left, Ari, let's look at a couple charts and think through them. One that I asked you about before we went live was Netflix. When you think of this sort of chart, you talked about this interplay between the short-term, maybe overextended nature, but then the long-term uptrend. Is a chart like Netflix setting up with a good combination of those factors? And what would you look for on a chart like Netflix to get concerned? What would tell you that the long-term thesis is starting to get shakier? Where would we need to see this sort of stock go to get less optimistic about it?
Great question, and I think it explain. I'd like to talk to some differentiation between some of these big stocks. And so for Netflix, for us, it's positive, but it's really not the best. As we think about large cap growth, I think it's not going to be the same large cap growth trade it was a couple years ago. We're seeing some different trends play out. For us on the tech side, looks better. This is a comp service name, and here's why. It has pulled back, no damage there. It's come right into its 50-day average, but it's where it's traded versus the prior cycle, that there's still a lot of overhead resistance from that 2021 period. You got that big gap at $500. So on any little bout of weakness, I'm going to doubt myself and say, oh, is this a longer-term downtrend resuming? I don't have that issue with Apple and Microsoft, if we could pull those up next. But just for Netflix, I would say, first off, you want to keep a tighter stop. So right off the bat, 50-day average, I think, is going to be the important chart, the level to hold right here.
When you're looking at Apple, you mentioned Apple and Microsoft. These are two names, obviously, that had an incredible run. Apple, just continuing to go higher. While others have pulled back, Apple certainly is not. What is it that draws you to this name? And particularly, you talked about how it's moved to new highs while others have not. How important is that?
Yeah, that's an indication of relative strength for us. We say we are momentum investors, so we want to buy stocks that exhibit, high relative strength. And the fact that Apple was able to clear that resistance that, let's say, Netflix wasn't able to do, is why we rank it above it. And why, as we think about if there is a setback, what's going to be on my buy list? Well, I know Apple's going to be coming into a lot of support. It's had that big breakout above its prior highs. That's going to be a good floor for it. It's got the 50-day average. I know I could defend Apple on that pullback. I could probably defend Netflix, but I'm not going to have as much conviction. I probably want to see Netflix carve out a little bit more of a base. Apple's going to be first for me. And I would note that was a particularly tough stretch for Apple over the last 2-3 years. If you look at the long-term rate of changes, that was one of the poorest performing 2-year periods for Apple going back over a decade there. So we think this strength and this breakout is legit, and how we see it, this secular uptrend in technology is just starting to get going again.
That's such a good point, Ari. And it's easy with how strong Apple has been in 2023 to forget how rough 2022 was. It even made a new low going into the end of the year, while the market, of course, bottomed out in October, started to swing higher. Apple was kind of in the back seat, sort of in the dust, as other things started to improve. We have maybe time for one or two more. I'd love to ask about energy. This is an area of the market, looking at the daily chart here. A lot of energy stocks reporting earnings this week. The XLE, the energy sector, has really rotated higher. You're seeing renewed strength from an area of the market like this that has been an underperformer really for quite some time. What draws you toward or draws you away from a sector like energy that has had a nice run here recently?
Glad you brought it up because in our latest report, we downgraded banks and upgraded energy. We wanted to kind of balance our exposure to cyclical value. Energy for us, again, it's the kind of the emergence of strength after a year of underperformance. If it's had a tougher year versus the rest of the market, I see this sector, relative to the market, looking very similar to how technology did coming out of the 2000 collapse and financials did coming out of the '08 crisis. You had a big surge off the low. That's what happened in energy from 2020 to 2022. And then you leveled off. So I think it's more of a long-term relative range, and we're finding the lower end of that relative range. But with the focus on selection, if I'm thinking about a potential long-term structural shift in energy, what are the stocks driving that? And I'm looking at stocks that have already cleared their 2014 and 2018 highs. You got a lot of E&P names in there like ConocoPhillips and EOG. When you at some time, anyone listening to this, pull back, long 10-year charts of Conoco and EOG, and you'll see these charts have cleared those long-term resistance levels from 2014 and 2018. That's relative strength. That's where I want to be in energy.
That is so well put. I really appreciate you talking about the strength and energy. I actually didn't know that's what you'd written recently, so that's perfect. Nice bookend of thinking about weakness and potential mean reversion to the downside in financials, potential upside for energy. We'll have to leave it there, Ari. It's great to see you. Thanks so much for joining us again on the show. Stay safe, be well there in New York, and we'll talk to you again soon.
Thanks, Dave. Take care. Bye now.
It's Ari Wald. Ari's the head of technical analysis at Oppenheimer. If you think about, so many great points that he made there. Think about how many times Ari brought up long-term charts. Looking at the weekly chart, we're thinking about energy. I'm thinking of the last month and last couple months, how we've had this rotation higher. Ari's thought is to go a little bit further and think about, a 10-year period on ConocoPhillips and see what sort of move we've had. When we talked about looking at the Nasdaq being overbought or overextended, being so far away from a key moving average, his answer was to look at the last 10, 15, 20 years and look at what's happened every other time that the Nasdaq has gone above that level. I've always appreciated Ari's work, and I think what you find is that focus on what's happening now versus what has tended to happen. Charts are, as one of my former analysts at Fidelity used to say, charts are the truth serum for the markets. A lot of times we get caught up in what should happen as opposed to what actually has happened. Great points there, a number of different ways on how the strength in the markets year to date really could mean further strength long term. Great take there, as always, by Ari Wald at Oppenheimer. Folks, we got to wrap the show and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Ari Wald, again, great take, and I loved his charts looking at the where we're at relative to key moving averages. Here's a chart I had in my in a chart list that I wanted to share with you. This is looking at the Nasdaq 100. I'm using the QQQ here, and I'm going back to the market top in 2000. And what I wanted to illustrate is we're currently right around 16, 17% above the 200-day EMA. And I have a horizontal line showing where we're at right now versus previous times that we've been that far above the 200-day EMA. And I think echoing a lot of what Ari said, that usually doesn't happen at the end of the move. This happens sort of in the middle of the game, maybe halftime at worst, where you tend to have further upside. The strength that we've seen and the momentum that has pushed us this far above a key moving average usually isn't the end of it. Usually has further upside to be had. Back in 2020, we got to 30% above the 200-day, and of course that was before another 18 months of further upside for the Nasdaq. So great take there, great way to think about the current overextended conditions and how those actually might be a good long-term sign. Chart number 2, looking at the 10-year yield. I mentioned in our market recap about the 10-year pushing back above 4%. I wouldn't be surprised if rates go higher from here. 4.1% is a key level of resistance. The way the CBOE quotes it, it's times 10, so 41 would be 4.1%. That's the level I'm highlighting with the blue horizontal line there. I think a break above 4.1% completes this rotation from a downtrend in rates that we saw for about the 6-month period through April, May, then a rotation higher lows for rates in June and July, and now completing that rotation higher. Rates have been going up over the last 3 months. What's not been going up is the relative performance of value versus growth. I wouldn't be surprised if that changes here over the next 4 to 8 weeks, which would be August and September. Tends to be seasonally weaker for stocks. Could mean growth takes a bit of a breather after this dominant period that we've seen since the October low. Maybe that gives an opportunity for value-oriented sectors like energy to start to do a little bit better. Finally, the chart of Apple. I'm showing the chart of Apple on a daily basis at the top, the 50 and 200-day moving averages. At the bottom, the accumulation distribution line. What strikes me about this chart of Apple, and again, I didn't really know what Ari was going to say when we brought up names like Netflix or Amazon or Apple. When I brought up the chart of Apple, he was talking about the strength, the fact that it's gone to new highs, the trend is positive. 100% agreed. One of the ways that I think is really interesting to illustrate that is using an indicator called accumulation distribution. Now, if you've ever looked at daily volume readings, it's a great way of seeing from day to day what the volume picture is and the relationship between price and volume. But if you're looking at that over time, you want to look at something that analyzes the trend in volume. Joe Granville came up with the idea of on-balance volume, but it's kind of a blunt instrument approach to looking at volume over time. Mark Chaikin improved on that indicator, in my opinion, using techniques like the accumulation distribution line, Chaikin money flow, both of which we have on our stock charts platform. The trend in the accumulation distribution line shows you how the strength in Apple has persisted year to date. And for now, as long as that line keeps going up, that tells you that there's continued accumulation implied by the relationship between price and volume. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the final bar. Make sure you check out our previous episodes. Last Friday, we did our top 10 charts for August. Really good way to review some of the key themes and charts you should be aware of. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.